All right, well, why don't we get started with introductions at least? And hopefully a couple other people will be joining us. So I think everyone here knows, well, I know you already. I'm Sarah Layton with Connecticut Resource Conservation and Development. This is through our CT Veteran Grown Initiative. It is backed by the Small Business Administration, and we are super excited to be bringing in trainings on a variety of topics, including marketing and business. And today we have Andrew Desiderio from Farm Credit East. He's a senior tax specialist, and he is going to walk us through the basics of farm accounting. So, Andrew, go ahead and take it away.
Thank you, Sarah. I appreciate that. Um, yes, so I'm with Farm Credit East. I work here in the Enfield office in Connecticut. I'm a senior tax preparer. I've been here for about 15 years in May. Um, I work mostly with clients in Connecticut, northern Maine, central Mass, and western Massachusetts. So I help a lot in tax preparation, accounting, a little bit of consulting, and basically financial services for farm credit customers. A little bit about Farm Credit. We are a member-owned cooperative, so a lot of our customers own a share of Farm Credit in the form of lending. So we offer, if you're not familiar with Farm Credit, we have a lot of services. We do financing and lending with our customers. We do crop insurance. We do obviously financial services, kind of what I do, grant writing, knowledge exchange, sharing information, customer insights. So we're more than just financial services and credit. So we offer a wide ranging of services. And so kind of getting into the details of today's presentation. So today we're going to be going over the basics of farm accounting, trying to give you a highlight overview of what accounting is, why may a company or individual be using it. There's a variety of different reasons why a company may use accounting services for their business. So just get into you know kind of the overview of accounting, why it's being used, the purpose of it, the type of methods, the common report types that a company generally uses, and then some tools. What ways can accounting be used? We'll go through, we'll at least talk about some of the concepts that can be used, the different types of entities within businesses, and the variations between some of the entities. And at the end, we'll follow up with a Q&A, and some additional resources that you can use or reach out to if this is something you kind of want to get more into. So before I get started, if anyone has any questions, I'll keep an eye on the text chat. If you want to unmute you can certainly ask a question, but I'll keep an eye on the text on the chat. But I'll kind of get diving right in. Record keeping, also known as bookkeeping or accounting. What is it? In hindsight, it's basically an organization of your financial data for your company. In essence, it's a snapshot in time, right? So it looks at the performance of the business and how it's doing at any given time. It really tells a story of your business. Why may accounting be done? Well, right now in January, we're kind of getting started for tax preparation. So now is the time where a lot of businesses will start gathering their end of year documents to either prepare for 1099s or W-2s or any type of year-end information to help for their tax prep. Outside of that, it can be useful for benchmarking, right? To see the general performance of the business, either quarterly, annually, semi-annually. It helps gauge a business to see how they're performing financially. Depending on the industry, insurance, a lot of workers' comp, Other liability insurance may be used to review the performance of the business to see how liable or measure the risk of the business. If you're looking for financing, a lot of businesses will have to show their financials on a credit information system for underwriting. If you're trying to apply for a grant from the state, they may want to look at your financials to see, how it may apply for funding. Tracking revenues and expenses, like I said, for profitability, also for tax planning before the end of the year, November and December, depending on if you're calendar or fiscal. Tax planning can be a huge value to see whether companies need to spend money or if it's an opportunity to, raise more money if they have some losses. So there's a lot of different reasons why looking at your books or your records can be valuable. And depending on how you're tracking revenue and expenses, every business is going to be different. There's not one size, fits all. It kind of depends on what type of business it is and how it's recognizing revenue and expenses. During this time of year, how you keep your records, how accurate and how organized can make a difference on how a tax return gets prepared. Obviously, the more organized it is, the more efficient and smoother it can go. When information is not so well put together, it can, be a little bit more challenging or no more time consuming to prepare. We'll go over the two main reports that get sent to tax accountants for preparing their tax return. We'll go into not very deep, but the common highlights of a balance sheet and an income statement. 1099s and W-2s are the most common statements that get sent at the end of the year. K-1s are more entity level, but they are common. Another reason why record keeping is important is to help maintain capital purchases. So we'll get into on the balance sheet what a capital purchase is. We'll go into the details of the type of accounts, but capital purchases are the large ticket items. So machinery, equipment, maybe some real estate, some land or buildings. And we'll talk about, how long should I keep receipts for or expenses like that. So first question that came in, besides QuickBooks, is there a record keeping software that you would recommend? QuickBooks has become increasingly expensive. Is FCE able to complete tax returns if a different software is used? I do have that as a topic, and I'll get to that a little bit later. So I'll try to circle back to that question. That's a great question. So I'll get back to that question. I'll hold that for now. So before we get into accounting, there's actually three, but I'll keep it down to the basics. Cash versus accrual. And then there is a hybrid where you can do a combination of cash and accrual. But for simplicity purposes of this, we're going to be talking about the cash method. So the cash method of accounting is where expenses and income are recorded when money is paid out or received. So that means when cash is exchanged in real time. So if I write a check to a vendor, I recognize that when I issue it. So whether it's money coming in as revenue or when expenses are paid out is the cash recognition. Accrual does not look at when money is received or paid out. It's the opposite. It's when it's incurred or earned. So a lot of that is looking at invoices and seeing when documents are dated, and not really looking at when it was received. It's looking at when the income was earned or when the expense was incurred. So that one, so you may ask, when is that more beneficial? Why may accrual be more beneficial? Accrual can look at more of the performance of the business. So you may not, a job may be completed. So say you work on a project, but you haven't got paid for it yet. That may, show that a higher earnings tend to be higher when on an accrual. It's better management can be better perceived on an accrual system versus a cash if you haven't got paid for it yet. The tax strategy for cash is you can tax strategize a lot. There's more advantages of tax planning with cash accrual versus cash accounting versus accrual. A lot of what we will be talking about in this presentation will be on cash basis. There tend to be more businesses on cash basis than accrual. There are some exceptions on when you must be accrual. That's for higher performing, more corporations over a certain threshold of income will be required to be accrual. But the purpose of this presentation will be focusing on cash. So digging into the details of revenue and expenses. So first, we're going to talk about the income statement. So we'll go through an income statement and we'll go through a balance sheet. And the biggest thing to keep in mind when you're talking to an accountant or you're looking at your records is understanding that the income statement looks at revenues and expenses. So revenue is sales that get generated from the sale of products or from a service that you perform. So that's money coming into the business. So you could sell an asset, machinery, equipment. If you receive insurance proceeds, if you receive rent, if you're renting out land or a building or equipment, though that's considered income. Interest you received on your checking account or a dividend that's in the name of the business. Tax refunds can be questionable depending on the prior year or if there's a tax benefit rule. Selling timber or wood or sand or gravel are considered income. So that's money coming into the business. Expenses are considered outflows. So cost. So the same. So likewise, if someone comes to your farm and performs a service for you, it's more than likely going to be a cost or an expense. Likewise, if you're buying and reselling product, cost for resale or cost of goods sold, that will be a cost for you, but it'll be income to your vendor. Likewise, the people that you hire to do your work for you, either an employee or a contractor. I'm not going to get into the differences between a contractor and an employee, but know that there is a difference between a W-2 and a 1099. Either way, either one of those is going to be an expense for you. The insurance that you have on your farm for your staff or for your business, any general repairs that you do for your business, utilities, payroll taxes, real estate taxes, excise taxes, fuel for your business, seed, fertilizer, chemicals. These are just naming a few. There's a lot more. I'm not, just in general. If you're renting your farm, if you don't own it yet, the rent that you pay is considered an expense. Interest on your loans, the interest portion only, not the principal portion. We'll get into the balance sheet in a minute. So the income statement, this is the general part of it. So here you'll see a sample income statement or profit and loss. Those are two synonymous terms. So the income statement that I have here is for 1 year, January to December. Again, this is on cash basis. And so looking at this real quick, you'll see that net income $1,745 is positive. So that would be considered a profit, where revenues are greater than expenses. If expenses were larger than revenue, you'd have a net loss. And so this is basically just looking at the money that was brought in and the money that was spent on operating the business. And what you won't see on here is all your assets. It won't. This is just showing you the revenue and the expenses. There's another report that we'll get into next, which is the balance sheet. And so a lot of the times when new beginning farmers come to market, we'll see a lot of either loans or a lot of balance sheet items, assets or liabilities that will be on the profit and loss. And so one of the things that I recommend is to really get a handle on what is a revenue account, what is an expense account, so that when you do run a profit and loss, the only thing that you should see is the money that you brought in and the money that you spent for the cost of the business. So capital purchases, so the purchases for machinery or equipment, no personal expenses, anything that relates just to the business should be on the books or the records of the business. So these are just a few. There's a lot more expenses that are out there. I kind of just tried giving you a sample of what one would look like. And so let's go into the balance sheet. The balance sheet is going to look at the assets, liabilities, and the equity in three parts. And then at the bottom, it'll tie out, the equity. And so this is an equation, essentially. I'll show you in the next slide, but basically assets. So assets are resources with economic value that an individual or company owns or controls with the expectation of a future benefit. So that's the legal term or definition of an asset. So what exactly are some examples? So cash in the bank, right? The money that you use to fund or source your business. The land that the farm owns or sits on, the real estate. So real estate, land, building, those structures are considered real estate. Equipment that the company uses, tractors, greenhouse tunnels, pretty much, large equipment, machinery. If your business has any patents, if they have something that's that they invented and they want to put a patent on it and say only we can use it, that's an asset. It's an intangible asset, but it's an asset. If your company has any investments, if they own stock in a business, that's considered an asset. Now liabilities is where, think of it as a credit card, right? Something that the company owes. It's an obligation or a debt to another company or bank. A few examples of that may be if they get product on credit, so an accounts payable. If they go to a Tractor Supply store or Home Depot and they want to have an account where they have an outstanding, basically, bill running, it's an account payable that they owe a future debt to that store. If they're financing or leasing their land and they have a loan or a note, seller, a lot of time, young farmers will go into business and the original owner will do a seller financed obligation or a debt where the original owner will hold a note and the new farmer will be paying a payable back. Credit cards, obviously, mortgages if they go through a large bank, More so for larger corporations, if they declare a dividend that they have to pay out in a future time, those are considered a liability to the company. Sales tax to the state for any sales. I'm not going to get into what's considered taxable items. These are just more general liabilities. If you're selling product that is considered taxable, that the amount of sales tax you collect is considered a liability to the state. If you have payroll that you pay your employees, both the employer share that the company is responsible for, likewise with the withholdings that are withheld from your employees, are a liability. So both of those are recognized on the balance sheet. I'll pause for a moment and take a look. Do you recommend cost of goods or inventory should be on the income statement or the balance sheet? That's a great question. For cash basis accounting, whenever you buy your product, usually that's recognized on your income statement. For accrual accounting is going to look at your inventory, and that will be recognized on your balance sheet. So it depends on the nature of the business. If you're trying to manage for taxes, cash basis is usually more generous because you write off your inventory as you buy it. On the accrual system, you put your inventory on the balance sheet, and then as you accrue, or as you are using the product, is when you expense it. So it's tougher to plan on the accrual side for inventory. It's much easier on the cash basis side because you can plan and manage it more. You can control that mechanism faster or easier. So it depends on the nature of the business. Does FCE offer assistance in legal? No, we do not offer legal. We recommend working with your own attorney for legal services. Unfortunately, it's not a service we provide at this time. Getting back to the equity section. So the last part of the balance sheet is the equity section. The equity section measures the value of the business that belongs to the owner. So that's going to look at a time, basically all since inception. That's going to be a revolving number as time goes on. And I'll show you where that is and how it looks on the balance sheet. But essentially it takes your total assets that the company has minus the debt that it has outstanding and equals the equity that the business has. So, and that is basically right down here. So balance sheet that I have here is for one day. Now you can compare. I just did this as of the last day of the year for 2024. If you wanted to do a variance or a change from 2023, you could have, I am only showing it for 1 year, but a lot of during tax time, you'll see two columns, basically one for 2024 and then compared to 2023, and you'll see the change from 1 year to the next for that one day. So this is broken out into basically three sections. You've got your assets, right? So these are your bank accounts. If you've got more than one, if you've got just one, and then you've got your fixed assets, right? Your machinery and equipment. These are just showing the totals. For your fixed assets, you would actually have a depreciation schedule, depending on the size of your business, a separate schedule that will track all your machinery and equipment, all your buildings, basically the assets that the company owns. If you're renting or leasing the equipment, then it wouldn't be on your schedule. It'd be on the person, whoever owns those assets. So these are for Andrew's greenhouse. So this would be, my business. So these are all the assets that this company owns. And so you'll see your fixed assets, 14,250, plus your current assets, basically your cash, 17,750. Now the liabilities and equity, this is broken in two different parts. So you've got your liabilities and your equity. So your liabilities are what the company has outstanding. So in this example, payroll and credit card. And this is for the one day, 12/31/2024. Now, when you get into the equity section, the equity is the retained earnings. So basically, that's the amount of money that it's the earnings, and it's retained, meaning it's kept within the business. This is what the company has earned and basically hasn't paid out. So the net income is, if I go back one slide or two slides, so this is for the whole year of all of last year. So January 1 to the last day of 2024, Andrew's greenhouse made $1,745. Now that net income flows into the equity section. So all of that, the revenue that I had, all the expenses, that one number flows to the balance sheet. And so that's where I was trying to, picture your business is going to have, basically, it's reporting two different things, right? A lot of people conceptualize their business as basically just a profit and loss, and they kind of forget that they've got all this other stuff, and a lot of that stuff will be on the balance sheet. So the balance sheet is basically just tracking everything that it owns, less what it owes to other people or businesses, plus the equity that it has or made throughout the year. So you'll notice that the assets equal, or the equity, liabilities and equities. So these must equal each other. Otherwise, your balance sheet is going to be out of balance. So assets must equal the liabilities and equity. So liabilities and equity, these two numbers, this whole section has to balance. Otherwise, you're going to have an issue. Does raw materials, work in process, and final product offer any advantages of farms? Inventory. I guess I'll have to think about that one and circle back. It's a good question. I guess it's going to determine whether how you track inventory, what the purpose behind it is. I don't know if there's any advantages, but I'll have to circle back. That's a good question. Ways to manage accounting. So here, one of the questions that came up earlier is the cost of QuickBooks is increasing. Are there other ways to manage my books and manage accounting? Well, before we had QuickBooks, we had the standard traditional pencil and paper. There's still quite a few farmers that do that today. They prefer not to keep anything in the cloud or online, which is fine. It's just more of a manual process. We have customers that use Excel spreadsheets. The business is pretty small. They can track their income and expense through their checkbook and kind of do it that way. The most commonly used is QuickBooks, whether it be online, QuickBooks Online, or the desktop version. The desktop version, I believe, is being phased out, and I believe they're trying to push more people to QuickBooks Online. We don't market or sell. We, as in Farm Credit, does not market, any of these products. The one thing I will say about QuickBooks Online is the QuickBooks Online version is more friendly if you're trying to collaborate with your accountant. If you want, you can grant other users a permission to view, to manage, to make adjustments. So I think that's considered cloud-based, right? Because it's in the cloud over a secure network. We have clients here at Farm Credit that use Centerpoint. It's a more advanced software, tracking a lot of different quantities. It's used in the dairy industry. Sage 50, formerly known as Peachtree. We do have a few customers that use that software. But for the most part, I'd say the market is dominated by QuickBooks, just because of the user friendliness of it, and it's very widely used. If none of those, if you prefer to walk away and say, you know what, accounting is not for me, it's just too mundane, I'd rather just hire somebody and give them my information, and then they can basically categorize everything and put it into a system, and then I'll get reports, whether it be monthly, quarterly, or just annually. You can hire a professional service firm to do that. With that does come a cost. It's probably one of the more expensive ways to go. If it depends on how much you want to be involved, because it's a lot of those services are based on time, and the more time that you give up, that means someone else has to do. The more that you are involved, and the more that you are doing the actual work, the more savings that you have. And so depends on the level of involvement that you want to have with the actual work. So going to the next slide. Other factors to consider. So with accounting, there are several types of entities. So you can be, the most common entity is the sole proprietor or single member LLC. So a single member LLC, in the eyes of the IRS, is a disregarded entity. So you'll be filing on a Schedule C or Schedule F, or if you're renting out property or equipment, or Schedule E. All your income and expenses are reported on those two. The balance sheet and the profit and loss are very similar. The general partnership or a multi-member LLC, when you have more than one member and you are incorporated with the state, you file on a 1065 or a partnership tax return. And the equity section down here gets tracked by individual members. So individual members, depending on their ownership percentage, will be tracking their earnings separately. And so the accounting gets more advanced, and some of the terminology that is used within the accounting changes, and the accounting treatment is not the same from a sole proprietor to a general partnership or a multi-member LLC. So this is where you may want to consult with a professional on how you track your balance sheet and how you structure your income statement or your profit and loss. This is where it starts to get a little bit more advanced, and the expenses get treated differently for different rules. A lot of the states have specific requirements on how you track income and expense for these entities. Getting a little bit further up the line is corporations, and there's, generally speaking, two types of corporations. You can have an S corporation, which is a subchapter S, and then you can have a C corporation. C corporations are a little bit older and more traditional. All income is taxed at 21%. S corporations, where the income flows through to the shareholder, and then the shareholder reports their income on their personal tax return, where the corporation, all the income is taxed at the corporation level and then that's it. The shareholders will get a W-2 or a dividend for the tax for their dividends that they get received. So I would say the most common one entity is a sole proprietor or single member LLC. If you've got a lot of liability, or if you're a higher risk, depending if you just want to be one shareholder as corporation, may be beneficial. I'm not going to get into the differences of which one's more advantageous than the other. That can be a whole separate segment on presentation. But for generally speaking, for most young beginning small farmers coming into farming, starting out as a sole proprietor, you can always advance or change into a partnership or a multi-member LLC. And if you want to, elect to be an S corp, you can do that. A lot of questions come up when business gets started for what should I keep, what documents should I keep, and how long should I keep them. The general rule of thumb is about 7 years, but I would say you never really know if you were to get looked at or investigated or audited. It's best to keep your information, all of it, for as long as you can. And why do I say that? The IRS, generally speaking, has a look back of 7 years. However, if they do find something in one of those 7 years that's material, meaning something that has a great magnitude that has an impact in other years, the state or the IRS can say, we want to go further back. This is gonna, this issue may have an impact on other years, and so they have the power to say, let's go back, look further, more than 7 years, because it's material. So at minimum, I would say keep your receipts, your large ticket items, as long as you can, because you may have to prove that basis or the cost of something. And if you decide to sell it years later, you can show proof that I bought it for this and then I sold it for that, or vice versa. And there's a lot of different ways today. Technology has grown so fast in the last couple of years of cloud storage. You can do it. You can take a picture of it and put it into your cloud cabinet, or you can do it. You can do it on paper in filing cabinets, but there's a lot of great tools and resources out there where you can store things electronically in the cloud. Just scrolling through the Andrew, how far back have you seen them look in terms of years? I had an audit probably 5 or 6 years ago. And it was an interesting audit. The audit was the customer did nothing wrong, and it was it was a federal audit, and it was a local within Connecticut, and they were using the customer as a benchmark for the industry that the customer was in, and they actually wanted to substantiate a large piece of equipment that was bought. I think they inherited it from their parents, and so the farm has been around a long time. And we basically had to say that the farm has been around since the 1900s, and they didn't have the piece of it was a silo, and they basically built it. And so they didn't get penalized for it, but I've had some instances where they're questioning. A lot of the questions are basis on depreciation. And so, I mean, it was 1 out of probably 1,000 returns, that we've done. But worst case, I mean, the one thing you can do is just try and save as much information that you can. And I know you're not going to save every, there's different. It's called de minimis. Anything under $200, they're not going to want to look at. But I'd say, large ticket items, you have to save every hammer, every nail, all these other, de minimis, items. But I would say Your large ticket items you're going to want to keep. Any other small expenses you go to the store for gas and stuff, maybe not so much, but your bank statements, your tax returns every year, payroll, your permanent records you're going to want to keep. In the event they have to show or make a stance on. Great question. Okay. Additional resources that you can go find, help or assistance with accounting. Believe it or not, the local library has an online database where you can look for information if you want to rent out some resources. There's a lot of good accounting companies that you can subscribe to, and you can get newsletters, out. The IRS itself, you can subscribe to irs.gov and get information sent to you every at your choosing. Connecticut Department of Labor, Connecticut Department of Revenue, my CT My Connect. There's a lot of great local websites on the Connecticut that you can subscribe to for different information. YouTube, I found a lot of good resources for sending for customers. Just getting into, I'll pick on QuickBooks. A lot of customers will ask, how do I do this transaction? Or how do I look up this? Or how do I build this report? With a lot of influencers out there today, there's a lot of people that are in the market for demonstrating how to do certain things. And so I found myself YouTubing how to do a certain, do-it-yourself project, right? So you got to be careful what you select, because there may be some things that may not be correct. So make sure you vet, the channel that you're subscribing to, and if do some research within your scope, because a lot of the internet references may not be as viable as you make, but there are some good ones out there. If you're a partner, or if you're someone in your business that this caught your eye and you want to learn more about how do I get a better handle on managing my business. I liked looking at the income and expense, the profit and loss, and seeing, maybe I need to hone in my skills a bit more. I want to learn more about accounting and get a deeper involvement and I want to if I'm the one that's handling the business, and I want to make sure, how can I help my accountant? Why is he always pulling his hair out and saying you have all these adjustments, all these adjusting journal entries? What can I do to make my business better? You may want to take a course at a community college. I know some classes offer, they may be free, they may be depending on your income level, or you may find benefit going to a local university and registering for a class or two, introduction to accounting, just to help you get an understanding of what your accountant is telling you, or for yourself on, what can I do to improve my books and records. This webinar is just to give you a glimpse of what accounting is, and some of the pitfalls that a lot of, some small farmers getting into the business of farming may run into. You can reach out to our sponsors here, for more resources that you may have. If you want to send me an email on some other questions that you may have, let me go through the chat here. Do you offer any insight or strategy to deal with grant income, especially if it is significant? So grants are a great way to provide a cost share into a project. And so do I have a strategy on how to deal with it? The biggest thing with grants are they are taxable up until the amount that you do not use the funds for. So let's say you had a grant for $100,000, but you only spent $50,000 of that grant for your project. The remaining $50,000 would be taxable. And so keeping track of the money that you spend on the project will be beneficial for your tax accountant to show that the taxable amount of the grant for you. So I think keeping track of how you categorize the income and then the expenses is going to be probably one of the two most important pieces. The one thing with grants is right now at the end of the year, whether it be the state or the federal, they issue the 1099, and the 1099 has a matching. There's a computer system with the IRS where certain lines on the 1099 you have to match up when you file your tax return, and so a lot of common notices get sent out to the IRS the following year saying, I'm going to use NRCS. It's the most popular, one of the popular ones. This company had issued you a 1099. When we looked at your tax return, we didn't see this amount was recorded or reported, and so the matching system is one of the pitfalls that we see with grants, and then recognizing the income. If you spent all the money, your portion of the grant, then it's non-taxable. It depends on if all the funds were used for that grant. How would you assess accounting services? Would you say all accountants are equal? If not, what questions would you ask when determining accounting services / accountants that would best align with your business? Great question. So I'll use so accountants. There's a wide variety of accountants. So there's accountants that deal with large businesses that just business to business. There's different accountants who deal with individuals and smaller businesses. So I would say if you're in the market for looking for an accountant, I would say you're going to want to try and ask them questions of, what type of business do you deal with? Are you dealing with nothing, lower than $20 million, or what type of customers do you work with? Farming, I will say, farming in taxes has its own separate tax code, right? So you're going to want to find this is a great question. If you're looking for an accountant, you're going to want to ask them what kind of taxes do they mostly prepare? Because there's in accounting, there's a lot of different industries, right? You could be a doctor, you can be construction, you can be even in agriculture. There's a lot of different industries within agriculture. You got dairy, you got produce, you got cranberries, services. So services, whether it's trucking or what have you. So the few items that I would want to ask myself if I'm looking for an accountant is, how long have you been in business for, right? How big is your team? Can you handle a new customer? Are you accepting anybody right now? How long do I have to wait? What do I need to do to get ready for you? Will you come out and meet with me, or are you just virtual? Are you even in Connecticut? Are you in California? Are you not in this country? So just like going to a doctor or a healthcare provider, kind of do some research and figure out, is this going to be a good fit for me? If inventory carries over to the next year, do you depreciate or just record as an asset the next fiscal year since the purchase was already expensed? We sell maple syrup equipment as part of the farm, so inventory can get high at times. So if inventory carries, so if you buy inventory, right, you put it on your balance sheet, and if you do account at the end of the year, we recommend counting inventory at least once a year. Usually when there's a time where at the end of the year, or depending on what your season is, where there's not a lot going on, so it's easier for you to count. If if you've got a lot of inventory coming and going, to do your year-end count, it's going to be tough. So let's say in a perfect world, you sell, I'll use maple syrup. At the end in December, if you don't have a lot going on, you can count and say, okay, this is what I have for syrup on the shelf, and it's not going to sell until the next fall or whenever, what have you. So that will carry over to the next year. The balance will stay the same. Once you start selling it or using it, whatever, let's say it's a product, then that amount will go down. So that's just going to be from one number to the next year, just changing time. That balance doesn't usually go away. I hope I answered that question correctly, or if I clear that up. For depreciation, depreciation is a whole can of wax. I'll try to answer depreciation as best as I can. Depreciation, it depends on what the asset is. The IRS has different class lives depending on what it is. So a building could be a general purpose building or a single purpose. Machinery equipment can depend upon whether it's new or used or the actual type of equipment. So a life will mean how long you can depreciate that piece of equipment over a certain amount of years. And so if you buy a piece of equipment today, let's say it's a tractor and it's brand new, that will have a 5-year life. So I can depreciate that vehicle basically, or that piece of equipment, for 5 years. And so if I depreciate it on year 1, then that amount will still be on my balance sheet for the next 4 years. So that number will keep carrying over, just like inventory, if that kind of helps answer your question. Any more thought in inventory, raw, WIP, when thinking about value and taxes? So inventory on your balance sheet may not be, it depends on what your, I guess I would have to take that one offline and kind of get more information on what you're looking for. So the question was, any more thought on inventory, raw products, work in process, final product when thinking about value and taxes? So I guess I may need some more input on one-to-one. If you want to send me your information, I'd be happy to kind of have a one-on-one with you just to get a better sense of what you're looking for. I'm just having a hard time understanding what on how to gauge that question. I'd be happy to have a conversation. Amanda, do we have anything that you see on your side?
I think you've kind of kept up with them, Andrew, unless anybody wants to unmute and ask questions directly. I think you caught up with the chat.
Okay, great. So I think this is going to be saved and recorded and posted on your website. If anyone wants to go back or take some screenshots and kind of redigest anything, feel free to shoot me an email. I'll be happy to follow up with anybody directly. Thank you for everyone who participated, and let me know if there's any other questions.
Super helpful, Andrew, and very insightful. And for those who may want to revisit it, it will be available on the ctveterangrown.org website, and also available on the CT Veteran Grown YouTube page. So those will be up shortly and available, and free to share out with other farmer veteran friends and other farmers in general. So again, many thank yous go to Andrew for coordinating this presentation for us tonight, and thanks for sharing your contact info for follow-up.
One last bit, we will have another presentation next Thursday on taxes. So if you wanted to have just a plug for next week, we'll go through the basics of taxation specifically for farming on the sole proprietor level. So similar to this, but on the tax environment. Stay tuned for next week.
Yes. Look forward to seeing you all there. Thank you and good night.
Thanks, guys.
Thank you.